Good afternoon. Thanks for tuning in. You're watching Countdown on BloombergQuint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking at this hour. Indian markets consolidate after 4 days of gains. Benchmark indices trade in a range-bound session, while the auto and real estate stocks are the principal laggards. Reliance Industries is the top point contributor to the losses, contributing 25 points to index downside. Aurobindo Pharma is among the top gainers on the Nifty 500 index post its third quarter earnings. The US and Europe formulations business saw double-digit growth in the third quarter. And Tata Steel, UPL, Britannia and NTPC will be the four Nifty companies reporting their December quarter numbers today. Good afternoon, Neeraj. Finally, I guess there is some selling pressure coming around the mark of 12,400. We've snapped the 4-day gains.
Yeah, 12,100 or 12,150 or thereabouts. Also, yeah, four straight day of gains, and therefore maybe a pullback was in the offing. I just want to, before we get to our markets, pull up what the Dow futures are doing and what the European indices are doing in the session today as well. Because remember, the US markets have had 4 straight day of gains too. So it'll be important to figure out if there is some bit of cool off there. Yes, the Dow futures too, not as buoyant as they have been the last few days. In fact, yesterday's close also was not as buoyant as the other few. And the European indices should come up on your screen for just a minute as well. A bit of a muted day, so no alarm bells, just about 0.5%. This could change as well. Get the heat map up on the screen and show you what's moving and what's not. Arguably some more red than green on the screen for the Nifty heat map. Yes, marginally at that, but no big losers, no big gainers. Autos have taken a back seat today. Tata Motors, Mahindra & Mahindra, Eicher Motors, all of which are down. Reliance continues. So after that brief pullback from sub 1400 levels, moving up all the way to 1450 or thereabouts, it's again given up 2 percentage points in the session today. So there's a bit of pain there. And financials today are taking a bit of a back seat. So you have IndusInd Bank, Kotak Bank, HDFC, ICICI Bank, all of them down. So what is doing well? Some PSUs like NTPC have done okay. There is some strength in Titan, and Nifty IT, which was a top drag yesterday, is probably seeing some shades of green with HCL Tech, Tech Mahindra and Wipro in the green. So, well, not a bad day for exporters, Devina, but the market breadth almost even Stevens, at least on the large caps.
We should look at the market breadth actually for the broader market space as well, to see how it's petered off towards the end of the trading session. So started off at the beginning, you saw a little bit of a wider gap, which is now starting to close in. So almost 1:1 in terms of the market breadth right now. For the mid caps and the small caps, this is what you've got. So not much of a move either. Mid caps are doing okay. Still there is an outperformance vis-a-vis what the benchmark index is doing, but small caps are absolutely flat. I want to quickly take a look at what's moving then within each of these spaces. Within the Nifty Mid Cap 100, in terms of the gains that are coming in from Varun Beverages, 8% higher. Remember, this stock yesterday and post results has been on a downward glide. Yesterday was down, I think, about closer to 2.5 to 3%. Today started off on a muted note, and now since afternoon to now, it's scaled about 4-5%. It was up about 3% in the morning, and now is up about 8%. Ajanta Pharma continues on the back of good numbers. You have IDBI Bank, JSW Energy, PI Industries doing well, about 3.5%, and Fortis Healthcare up about 2.5%. Indraprastha Gas is down on reported numbers. Ubra Realty is down 2%. Manappuram Finance, Torrent Power and Edelweiss, after yesterday's initial pop of about 6.5%, is down 1.7%. Within the small cap space, we've got a Wellspun Corp that's up about 6.8%. Avanti Feeds makes a comeback, 4% higher for Avanti. Metropolis on a good set of numbers. Management is extremely positive on the way going forward as well. Lakshmi Machine Works 2% higher, and losing out is Gujarat Alkalis, that's down 5.5% on numbers. Venki, Credit Access, Grameen, Delta Corp, fertilizer stocks are looking weak. So RCF and Chambalford are all down, and Spandana Spurti is down about 2.5% in today's session. But important to keep track of what's happening in the futures and options space as well. Navneet joins in for that. Navneet, good afternoon.
Good afternoon, Devina. Finally, markets are taking some breather after the rally of last 4 sessions. So pull up the Nifty futures as well, which have been trading at a discount for last 5 or 6 sessions now. Despite of today's correction, one would have thought that the futures would have moved into premium, but that's not not happening at all, and we've not seen much of unwinding coming in on Nifty futures, while the markets have recovered nearly 3.5 to 4%. Pull up Nifty Bank. Remember, Nifty, by the way, has breached its 20 and 50 DMA. It's trading below that, but Nifty Bank is still trading above the 20 DMA, but below 50 DMA for a really long time. I think for last 1 month, Nifty Bank has been underperforming. Some signs of positions being taken there. Open interest is up about 16%. On the option side, what levels to watch out for Nifty? Of course, clear support will come in at the 12,000 mark, but the 12,100 call has seen fresh writing today. Almost 10 lakh shares have been traded, and even the 12,100 put seems to be active. So not as much as how on the call side we've seen addition, but still 4 lakh shares have been added there. And 12,000 put, as I said, will be the first support for the markets if we were to trend lower. So that's seen additional writing of about 5 to 5.5 lakh shares. The near-term range remains same, 12,000 on the downside to 12,200 on the upside. Very quickly then on the stock future side, Aurobindo, which has reacted quite positively to its numbers. It's up nearly 13% for the week. With the move that we've seen this week, it's also crossed its 100-day moving average and long position seen on the future side. Divi's Laboratories, another pharma counter, which is quite active. It's touched its fresh highs in today's trade, and this one's been a top pick within the pharma pack by a lot of market experts we've been chatting with. For today's trading activity, almost 35% of the traded quantity has been marked for delivery, giving you an indication that it is cash-based buying also alongside long positions on the futures side. DLF is the other one. I think post the numbers, the stock has been down. It's down for the second day in a row, and it has been taking support at its 50 DMA. If you look at the trading activity on the future side, it's giving you some sort of signal that maybe since the stock had run up a lot, you are seeing some signs of shorting coming by. The stock's down 3.5%. I think it's day's low as well, and open interest is up about nearly 7% in trade.
All right, that's what we've got in terms of the overall market mood. Let's begin the show with capital allocation and cash hoarding amongst Indian companies. IiAS has conducted a study which suggests that 60 out of the BSE 500 companies can, on a conservative basis, return 88,600 crore rupees of surplus cash on their balance sheet to shareholders. Out of these 60 companies, only 5 of them aggregate over 50% of the total distributable cash. Let's discuss this in greater detail with Hetal Dalal, the COO of IiAS. Hetal, thanks very much for taking out the time. That's a big number, 88,600 odd crores in terms of surplus cash, and that too on a conservative basis. And if I'm not mistaken, that figure too has come down from a number which was over 1 lakh crores.
That's right. 88,600 crores is effectively, I mean, if you look at, just put it in context, the government wants to raise 90,000 crores by disinvesting some stake in LIC. So this is almost that kind of quantum. The number is large. It's come down from our assessment last year. Last year the number was 1,08,000 crores. And one of the reasons why that number is reduced this year is that corporate performance has been relatively weak. A lot of the companies did do buybacks. And if you look at the public sector, there's been an increase in the capital expenditure that they've incurred. So their on-balance sheet cash has actually been lower. So given these 3 broad reasons, we've seen that the number has come down from 75 companies to 60 companies, and the excess cash that we estimate is come down from 1,08,000 crores to 88,600 crores. But having said so, that's still a sizable number, sizable quantum of cash which we believe is on the balance sheets of these companies, and it aggregates about, if you just look at it in terms of the total quantum of cash, it's about 1/3 of the cash balance. At a median payout level also, it will be effectively 50%. So the number effectively is still conservative. Companies could pay out more, but when we're looking at the estimate, we will look at it from the basis of what we see in the balance sheets. Boards, of course, are the ones which need to decide on the capital allocation philosophies for the companies.
Right. So Hetal, according to you and your study, do you feel that this is the right approach to cash allocation and the use of cash on the balance sheet? I mean, most companies would like to withhold some amount of cash to make sure that they can, invest in organic or inorganic growth potential for the company. So according to you, is this the right use of excess cash?
I think there is definitely a case to be made that companies need to maintain a certain degree of cash on their books. One is, like you rightly said, for organic and inorganic growth. The other could be simply contingencies. The question you have to ask is how much is enough? So when we looked at arriving at this number of 88,600 crores, we adjusted for the total quantum of debt, adjusted for 50% of contingent liabilities, adjusted for potential capital expenditure, adjusted for potential growth in working capital. We've also adjusted for all the acquisitions that have taken place, the buybacks which were announced, and the dividends which have been paid out. So pretty much all the use that the company will have for cash, we've taken that. Then we've capped it at 50% of net worth. So again, we've taken a filter there. So if you look at the sort of filters that we've applied, this still is a conservative number, and therefore we believe this is incremental cash which can be distributed to shareholders. So if you look at even how sort of SEBI's moved on this entire issue, right? We've been talking about cash hoarding and balance sheets for about 5 years now. SEBI also came out with the requirement for companies to have a dividend policy exactly in this context, to ask boards to have a more thoughtful capital allocation policy. And that's really what we are also saying, that companies need to be, boards need to be more thoughtful about how they look at capital allocation, how much is to be conserved and how much should effectively be distributed to shareholders.
Hetal, on the back of that, now post the budget, now the debate stands open as to what kind of route that the companies can take to put back cash into the hands of shareholders. I mean, there is a split between the fact that now with the removal of DDT, a lot more activity will start on the buyback front. What's your sense?
So I think it's going to get driven by the ownership structure of companies. When there is abolition of DDT, MNCs are likely to look at that more favorably. On the other hand, if you look at the taxation which has come on the personal taxation side, with the abolition of the DDT, I think promoters are going to sort of think about what it means for their personal finances. And of course, in all of this, you still have a buyback tax of 20%, and therefore companies will debate what is the more efficient mechanism out of all of these three. I think having said so, while we do believe that the ownership structure is likely to decide which route the companies take, there are a couple of things that we would just want to raise. One is that of the 60 companies that we've looked at, about 1/3 are MNCs. Given that the dividend distribution tax is getting abolished, it's likely to be more favorable for them. The residual companies, of course, have ownership structures. For PSU, there is a requirement for the PSUs to kickstart the capital investment cycle, and for promoter-owned companies, I think there is a compulsion on the personal taxation front. All said and done, I think what companies need to look at is to have a much more predictable philosophy around dividends, and avoid making these decisions based on a taxation structure. There's definitely a need to be more efficient about capital, about how you distribute surplus cash. But the first fundamental question is, how much is excess and how much are you actually going to distribute? So this is going to play out based on ownership structure, given where the taxation scheme is. But we do recommend that there has to be a certain degree of consistency across when dividends are being paid out, rather than have, let's say, a 30% dividend now and a 0% next year. I think that does not augur well from an investor's standpoint.
Hetal, I just have one question. In your first answer, you mentioned 88 or closer to 90,000 crore is something which the government is also looking to get from its divestment target. Looking at the list of companies as well, not seeing a lot of these PSU companies, which usually, a lot of these investors buy because they are a good dividend play as well. What is your take on that? Can the trend change? And we understand, I guess, they were trying to do a lot of capex in the year gone by. Do you see that trend continuing?
So, if you look at how PSUs have been paying out the excess cash, if you look at it, let's say 2 years ago and even 3 years ago, there was a huge dividend payout. Coal India did an exceptional dividend. There were also a lot of buybacks that a lot of the PSUs went through, and all of this was in the context of returning excess cash to shareholders. Be it as you may, if independent of the compulsions that the government may have had at that point in time, the PSU still had excess cash. The government is now suggesting that the PSUs will be used to kickstart the capital investment cycle. And if you look at FY19 and the capital expenditure which has happened within the BSE 500, the capital expenditure has grown for the BSE 500 list of companies, but that growth has come largely from public sector enterprises and Reliance Industries. So you are seeing public sector enterprises focused more on capital expenditure, and therefore the excess cash may likely be driven towards that. If there is an excess, it's reasonable to expect that that will be paid out to shareholders.
Last question, since we're talking about a sum as close to 90,000 crores in terms of dividend payouts, what does this do to some of these companies and their dividend yield means? Do you think that will get skewed significantly?
Yes, I think if you look at so let's put in context, right? Let's look at the profitability of these 60 companies. The profitability of these 60 companies has been significantly higher than the residual BSE 500. Having said so, the return on equity has actually dropped, and that's largely because of the efficacy of capital use, because the cash is sitting on the books. From a dividend yield perspective, the median dividend yield right now for these companies is about 1.1%. It jumps to about 3.8%. But for I think a set of 5 or 6 companies, the dividend yield is almost up to 15% if the excess cash is paid out. So there is a lot of the dividend yield growth can be substantial if the excess cash is paid out for these set of companies.
All right, got it. Interesting read, Hetal. Thank you so very much for joining in and discussing the same with us here on the platform. Back to the markets then, and let's bring in a market voice. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, is joining us right now on the show. Sunil, great to have you with us. Give us a sense of how you are reading the market dynamics right now.
So basically, I think that India, despite the slowdown that we faced over the last few quarters, suddenly we're finding that relative to the rest of the world, the market is very attractive for FIIs. The reason for that is that I think the budget was a very strong statement on the government's philosophy of not exceeding the fisc. I think that was very clear. Second is the quality of the expenditure of the government was also more capex rather than revenue. And even the dividend distribution tax removal, I view it as a corporate tax giveaway on top of the 45,000 crores. So I think that quality of our expenditure, I think is good. And I think the Brahmastra of LIC's disinvestment, I think gave a big fillip. And if you actually link the two at the back end, I would link DDT removal to LIC disinvestment. Because if you want FIIs to participate and make the disinvestment a success,
you save some money from them.
No, LIC is the biggest dividend payer. Yeah. Government is always going to take. So if there was a DDT, it automatically brought down the valuation of LIC in the minds of a foreigner. So I think clearly the DDT tax itself was oriented towards FIIs and FDI. So I think that's where, if you see, that giveaway is clearly a corporate incentive. So to us, that's strengthened the confidence of foreigners that ultimately growth will return in India. And I think a lot of green shoots we are observing right across a lot of industries in terms of pickup in growth. Automobiles, consumer durables, all the news is not as bad as before. And so we retain a very positive view of the market. And if you see, the inflows into mid-cap and small-cap funds have also sharply risen.
January was a good month, I believe.
January was a good month. The actual data will come out, but at our counters, we saw a good 20% growth month over month. So I think the return of the smart investor to, because you're today having mid-cap index at a 11% discount and a small-cap at a 22% discount. So I think the feeling that it can't get worse, and it may take, and that's why you see those indices have delivered 14 to 16% in the last 6 months. So the early movers have got the advantage, have made money. So I think clearly risk is coming back on the table from a market perspective. And if you do study multi-cap funds, you will observe that multi-cap fund managers have also gradually increased their small-cap and mid-cap allocations within their multi-cap portfolio. That is the best way to judge what the market guys are doing. Because in a large cap, SEBI says this much, mid-cap they say this much. So they will fully use. In the multi-cap where the flexibility is there, if you track, I'm observing, and our fund also the same, is that we've gradually increased our mid and small cap allocation. So I think that's our read in the market, that it's a good time to invest. That being said, I would see valuations actually creeping up over the next few months. So the other thing which is going to happen is the market is still reading the future. So in that sense, the EPS growth will lag the market price rise. So you will see over the next 3-6 months valuations actually going higher and higher. and a sense of people questioning, saying, is it worth it at this valuation? Is it worth it? So that's a delicious time that's coming up in the next 3 to 6 months that we all would have made money on the market, but you'll be worried whether we should stay in the market.
That valuation dilemma will
Yes,
always be
it's
there, because
definitely-
we've seen only a polarized move in last 2 years.
Absolutely.
You said it's good time to put money into markets. What are the cash levels that your funds are sitting at right now?
No, we are only at 3 to 4% in cash.
And you've been deploying, you said this
We've
month.
been steadily deploying, and the funds which are getting money are our large and mid cap and our multi cap fund. So luckily for us, there is still a decision to be made at our end on where you put it. If we were getting only into our mid cap or only into our large cap, then that would straight away go there. And so the opportunity to keep cash also is not there, because once we get in a multi-cap, we can have a broader bucket in which to
This
deploy.
year actually started off with that theme, maybe broader markets can outperform, and so far, at least till now, we've seen that outperformance, but as you rightly mentioned, still there is a discount compared to the frontline indices. Do you think then all the negatives are priced in now, be it at growth level, macro level? We're done with the budget, and now a lot of people are terming this as a non-event because the markets have recovered from those lows. The budget actually was good for the FI community as well. From here, from the current levels, do you think if the markets were to rally, the outperformance from the broader markets can continue?
Absolutely, because see, the next big event, according to me, apart from the Delhi elections, is the Trump visit to India. And then you'll have the headline of some kind of a trade deal being signed and stuff like that. So I think that will give another boost to the markets. And I do expect that our initial read of the earnings season is that it seems to be fairly decent compared to the previous quarter. From whatever footprint we have seen so far, we're seeing that the banks, for example, have started doing well now across the spectrum of large, mid and small. Early only the large and the larger mid banks were doing well in terms of, so clearly the NPL cycle is turning down. Loans have grown. I think you saw in RBI's report also that consumer loans and auto loans have grown fairly decently. So I think the only risk to the market is that the market's expectation of the pace of the recovery and the actual recovery, I think there's going to be a disconnect, because at the ground it is going to take time. Let's face facts. So that's why I said valuations are going to be getting stretched in terms of that the promise of the future is what is going to keep the markets buoyant. But the reality is going to take a little bit of time to catch up, and we are going to face that decision in a few months' time.
Are you expecting a reclassification of mid-caps and small-caps?
I think it's definitely something that SEBI is looking at, and I do hope for a widening of the basket.
How will that change things materially?
So what happens is that if you look at it, right, they have given 150 stocks in the mid-cap space to the fund managers to deploy, right? Now, the 150 stocks, no fund manager goes blindly buys mid-caps. So first of all, there are only 70 odd stocks in the mid-cap index from the mid-cap universe. Right, so 150, so if you're trying to beat the benchmark, you can't ignore a benchmark stock in a mid-cap. Right, because you would like that predictability, because one is absolute performance, one is relative performance. So your focus comes to those 73 stocks, and either you try to buy them or something very similar to them. Second is, every fund manager in the decision-making process doesn't go by large cap, mid cap, small caps. He goes by economy, sector, company. And when he likes that. So even though you may give me money in a mid-cap fund, I'm going to buy mid-cap stocks only in that sector which I think is worth the buy. So then my universe gets compressed, because a sector which is clearly a no buy, I can't buy it, though it's there in mid-cap in a significant, like say consumer, for example, or a consumer non-durable.
It's a theme-based approach.
Yeah, because fund managers' research can't be on large caps, mid caps. No, that's too generic. A fund manager researches sectors and stocks. Sure. And so you give me money, but I am, like I've seen that mid-cap and small-cap funds in this 9 months have given about 17,000 crores of inflows. Pure large-cap funds only have got 11,000 crores of inflows. ETFs apart, okay, actively managed fund. So when that much money is coming in, and I'm favoring only a certain sector, every fund manager is going and buying that, you're getting that polarization element coming in there. Now in large-cap, chalta hai, because there is still liquidity to get out. But in mid-caps, so I think SEBI, the case has been made to SEBI by various people. SEBI is considering. I do hope when they come and give, the flexibility can be in two forms. Either you widen the basket of mid-cap stocks from 150 to 200, or alternatively, what you do is instead of 65% minimum in that segment, you broaden it a little more, whichever way it works, because
Okay. I have one final question, and that is an obvious one, but I want to hear it from you. If people were present in the dividend option, suffice to move out of that completely because of the budget and get to growth?
So there are two types of things here. So you're talking about the mutual funds dividend options, right? So first things first is that the idea of switching from a dividend option to a growth option of your existing investments is fraught with risk because there will be a capital gains element. Even a switch of an option from dividend to growth is treated in income tax, you're redeeming. So a tax element comes in on the switch, one. Two is that to the advisor who manages his customer, a person at the lower end of the thing, nothing has changed. Because there's a 10% DDT was there earlier, now there's a 10% TDS, and if he's at a 10% bracket, then it's neutral cases. So the advisor-distributor combination, advisor-customer combination, we'll have to look at this and say, what is my thing? The third thing is, there is an option called an SWP. Now, since the people came in with an idea that I want regular income from my investment, and that's why the dividend options were marketed, you have to simply stop. The fund houses, I would gradually reduce the dividend, keeping the customer's interest in mind, and these people can introduce a systematic withdrawal option. And you see most funds, for example, the regular dividend paying funds already have a 10%, our fund for example, has a 10% exit load exemption. So up to 10% of your principal, you are waived from the exit load. So that is ideally conducive. Up to 10% you can do a systematic withdrawal and you don't suffer a tax, or if you suffer, it's a 10% on an LTCG or a 15%. So I think there is still ways around of this, but pure coming to a dividend option in the expectation that dividend being your regular income, I think you can write the obituary notice for that.
Okay. On that note, Mr. Subramaniam, take a moment to thank you for joining it and giving us your perspective.
Okay. Let's move away from that and talk about what the moves banks are taking after the RBI policy, which did a lot outside the monetary policy framework to aid growth, prompting some experts to say that's did a Draghi this time around. Well, the central bank's thrown in a lot of sweeteners for banks to lend more to real estate, auto, and also MSMEs, and has also given an option to get a long-term repo option to banks. Joining us now to talk about the RBI action in the room it gives banks is the Chief Financial Officer of SBI, Mr. Prashant Kumar. Mr. Kumar, hi, good afternoon, and thanks a lot for joining us today on BloombergQuint. I guess you all have lowered the MCLR rate by 5 basis points, and you've also cut down on your deposit rate. Since both these moves have come at the same time, will it be suffice to assume that this will not have any sort of impact on margins?
No. Because like the impact of 5 basis points on the MCLR has come out because last month we have reduced the rates on the deposit side. So it's a margin agnostic. And whatever reduction we have done yesterday on the deposit side and what RBI has taken the measures in the policy, I think that impact would come next month.
Okay. Before I move ahead to your take on RBI policy and the sort of measures that they've taken outside cutting the rates or not cutting the rates, will all this impact, or if you could tell us, is the loan growth picking up for the bank?
No, I think this is a statement like where the bank is encouraged to give loans to these sectors. Okay, so this is I would be saying an additional push. Additional push in the form of an incentive to the bank,
right,
that where you to have a lower CRR, equivalent to the loans which you give to these sectors.
Sure, it's for retail loans where the RBI has said to do away with that CRR requirement if you're lending out loan for housing or for autos. Do you think it's a kicker? And it can actually push this sort of segment in terms of, disbursing loans going ahead?
No, I think it would definitely help because the message is very positive. Sentiment would improve. And the banks are already, trying their best to push credit into these sectors. But I think this will further boost.
So what was your take on the LTRO? And the repos being... All right, I think we lost him. Sir, can you hear me? All right. I think we've lost the line there, but he said that this is something that we are going to see even come next month, because they've not yet factored in the policy changes from yesterday. So you may just land up seeing one more cut following through in the next month too. SBI as a stock has been recovering. It's, I think, closer to about 320 now. So broken that range of about 312 to 315 that was stuck in for some time now, but it's still down about 0.25%. Back to the markets, the Nifty 50 is still trading under, but we're holding on to 12,000. It's below that 50-day moving average. Nifty Bank is down about 99 odd points. I think we've got Mr. Kumar back on the line with us. Mr. Kumar, just one last take with regards to the announcement of the LTR on what was, in how big a positive is this for making sure that there's enough and more transmission happening in the system?
Yeah, basically there are two things. One is the assurance from the Reserve Bank of India that they would continuously provide the liquidity support to the banks. And another big change which they have made, instead of a daily repo rate, they would be providing liquidity for a longer term. So basically it's the message, like without reducing the rate of interest on the deposit, you can lower your cost on the entire fund by borrowing from the RBI for a longer term. And that you can pass on to your customers.
Okay. So a significant positive according to you. Do you feel that that would, how soon can this come with regards to or reflect in terms of the overall disbursement for the industry in general?
Yeah, absolutely. I think it would further lower the rates and without affecting the interest of the depositor. Okay, and the liquidity assurance has come from Reserve Bank of India, and already system is witnessing a huge liquidity surplus.
Okay. All right. So at this point, there is no concern with regards to the credit flowing to the customer, right?
Should not.
Okay. Got that. Mr. Kumar, thanks very much for joining us. Appreciate you taking out the time. As the management of SBI talking about the recent MCLR cut that they've taken. More to come on in the next month or so. Back to the market then, Shitij Gandhi of SMC Global Securities. He's joining us right now on the show with a quick take on the technicals. We'll soon be joined by Brijesh Shah as well as Mridul, Jalan. Shitij, I want to come to you on the index first. Any trade on the Nifty or the Nifty Bank?
We have started today's session on a negative note, and currently we are trading in a red zone after a 4-day of consecutive gains post the budget. And the losses we have witnessed on the day of budget, that the losses almost have been recouped in last 4 trading sessions, and the kind of recovery from the lower levels we have seen from last four consecutive sessions, it clearly shows that the shorts are on back foot as of now, and the prices are actually witnessing a long build up into the prices, and in today's dip can be considered as a kind of a profit booking after a steep rally from say lower levels. And on a technical front as well, the Nifty and Bank Nifty, both the indices have recovered sharply from the lower levels after testing their 200 days exponential moving average. So all this scenario keeping in the mind, I would be rather comfortable taking a long position Nifty for the coming week, or say for one last hour of a trade as well. And from a derivative front as well, we have been witnessing, heavy put writing happening into the 12,000 and 11,900 put strike. So as of now, overall the structure has become positive onto the technical charts, and on a higher side, I believe once a move to above 12,120 levels could once again add a follow-up buying towards 12,150 to 12,200 levels in Nifty.
Okay, that's the call on Nifty right now, which is just about trading at levels of 12,100. Shitij, in terms of individual stocks, what are you betting on this afternoon?
Yeah, exactly. As of now, I would be betting. I have 3 buy ideas for today. The first stock is Hetal. Currently, stock is trading around 630 odd levels, and we have seen the stock has not been a performer in the recent rally we have seen in particularly index. So if I look at the technical structure as well, Hetal has given a short covering from the lower levels after testing 600 levels, and from the derivative front as well, the call writing which have been observed at 620 call strike, the call writers seen covering their short positions, and I believe the short covering can be seen in coming days in Hetal as well. So on a higher side, I believe Havels can test 640 to 645 levels, keeping a stop loss below 615 from here on. The second stock would be from the IT counter. The stock is HCL Tech. Currently, the stock is trading around 605, 606 odd zone. And from the technical setup, the stock is consistently maintaining its bull trend and can be seen trading in a higher channel by making a formation of higher high, higher bottom on daily and weekly charts as well. So I believe the HCL Tech can also witness a follow-up buying from here on, keeping a stop loss below 590 levels from here on. One can take a long position for an upside potential of 630 to 635 zone. The last stock would be again for a buy side in the stock is United Breweries. Currently, the stock is trading with a losses of say nearly 1.5%. But if I look at the broader structure, the stock has given handsome gains from the lower levels, say from 1270 to 1340 from last 2 to 3 trading sessions. And today's dip can be taken as a buying opportunity once again in UBL, because on a weekly charts as well, the stock has given a consolidation breakout. So one can take a buy position in UBL by keeping a stop loss below 1285 levels for upside potential of 1380.
Okay, some stock ideas coming in from Shitij. Mridul Jalan of Senora Advisors is also joining on the show. Mridul, great to have you. Good afternoon to you.
Good afternoon.
Any tweaks, any changes on the back of the budget or the policy that you've made to your existing portfolio, where weightages have changed, where you would like to assign some more weightage to any particular sector or space?
So just before the budget, we went a bit cautious in the market because of the levels. Budget was a bit disappointing, to be honest. While I must say that what happened in the policy comes at a huge positive surprise to us. My nutshell view is the government has disappointed on stuffs to be done from their end to bring the economic growth back. RBI is doing everything they can. What they are doing to bring the short-term yield curves down so that the lending and the working capital cost comes down for the corporates is amazingly well. The kind of stuff they have taken up to bring the stress of MSME lending and everything coming down gives a lot of boost to the hope in terms of the short term. What government is doing is balancing it in terms of the long-term structural stuff. So broadly, our view remains the same, that earnings will take time to come. This market is a buy from a medium to long-term perspective, but what we are seeing since the recovery post the budget is more to do with global rather than anything. So we continue to be cautious in the market. We'll probably be a buyer 3 to 5% lower, but we will not panic and participate in this rally.
Okay. Well, some numbers, just looking for some numbers. I think Symphony is up about 8% in trade because I reckon they've declared an interim dividend of 20 rupees per share. The consolidated PAT, I reckon, is coming in about 51 crores, reading from the wires, and revenues at about 2.9 billion or thereabouts. Just waiting for the further confirmations, but I think this interim dividend has just gotten the stock excited. 9.5% now up for this one, 1358 and counting. Voltas was the other one that came out with numbers today. So cooling solution companies, two of them, the premier ones, the air conditioner leader and the air cooler leader, both have come out with numbers, and both of them are actually doing well. Voltas numbers actually missed estimates. Mridul, I don't know if you looked at them. Symphony, we're waiting for the numbers to come out on our flashes, but they have apparently declared a large interim dividend as well. What are your thoughts on these two?
So we don't look at Symphony,
okay.
but we look for a cue from Symphony. So even for Voltas, if you look at it, the air cooling business has done pretty well. Whatever disappointments have come on the other two aspects of the business. So it is in line with what Symphony said. It's a natural, which means that the consumer demand part of the business has done better than what the street was expecting. Air cooling business for Voltas is where the major multiples and major part of the earnings come from. So my point is, festive season has done well for these guys. That's given in the numbers. What next? That is where we are concerned.
So you're waiting for the call? Are you waiting for to hear from the management?
Exactly.
What about the channel checks? What about some hypothesis that you have about what could happen to Voltas in the near term?
So I will be slightly cautious on Voltas. We don't hold it. That's a disclaimer. Will I be buying it at these levels? The answer is no. Do we like the businesses? Yes. But we believe that the stress in the system will be seen by these companies also, especially on their project business and stuff. Typically, air cooling business do pretty well both in festive season and the summers, right? It is this quarter between Jan to March which is where the real stress part remains, and where the way the winters are a bit and now that they are catching up, I really think this quarter could be a worry from a ground level perspective.
But these, from whatever little I gather, these are blockbuster numbers from Symphony, by the way. I think there is a growth in margins to the tune of 400 or 500 basis points, and both revenue and bottom line too have expanded. So I think they've done well on the revenue front. The margins have looked strong, and the bottom line expansion has happened. Add to that the sweetener on the dividend, special dividend of 18 rupees, interim dividend of 2 rupees. And the stock is certainly doing well for itself. Well, let's wait and watch. 1387 and counting for Symphony for now. Margins is the key thing that we have on your screen. The EBITDA margin at 23.4% versus 17.9%. So that's, well, around 550 basis points of expansion. No surprise that the stock is doing what it's doing. I'm not saying this is warranted. It's not a cheap stock. Viewers, keep that at the back of your mind. But maybe tide is turning for this one. So let's wait and watch what happens there. What else in terms of results have you liked? One mid-cap name wherein you'll really like the results.
So, couple of things where we are more of a large cap guy rather than the mid cap.
But surely you have some mid cap exposure.
So we like the results which came from Manappuram in terms of the gold loan growth. We slightly in the large cap side. We like the results of Pidilite. They reported good numbers. Burgess numbers were good, but the stock is expensive. So numbers have followed. Numbers are better than what the street was expecting, which means that the festive season, the pent-up demand did unwind in the festive season, as we can see from the consumer numbers. What is important is to see what happens this quarter from a fundamentals perspective. Hence, we probably will be more cautious coming from the nature where we come from, and we'll wait for what happens in this to realize whether it's a cyclical part or the structural part, where the negativity is only in comments, but the consumer spending is there. So this quarter becomes very important from that trend perspective, because we know what happened in the June to September quarter. People didn't spend. So was whatever happened in October to December is just a pent-up demand, or is the mood change? You will only realize once you look at the Jan to March numbers. That becomes very crucial for us.
Okay, that's about certain numbers. And Neeraj, you were talking about the special dividend. They're distributing nearly 140 crore as dividend, including the special and the interim dividend for this year.
Talk about use of cash.
Yeah, good capital allocation policy, rewarding the shareholders.
One would have thought buyback would happen because of the latest changes, but nevertheless.
Yep, I think for this financial year, both are attracting taxes. Buyback has 20%, and even DDT will be from next financial year.
So market rewards people who throw the cash which they earn. If they start distributing it, which clearly means that the cash income is strong.
Right.
And hence those companies will trade at multiples at which Symphony is trading.
Okay, that's about Symphony. Let's also address a couple of other stocks then. You've got Z, which is recovered today. It's up about 5%. I think there was a mild bit of recovery that was seen in yesterday's trade as well. NTPC is seeing gains. These are your nifty constituents which are doing good. UPL also seeing gains about 1.5% ahead of its numbers. But it's Aurobindo Pharma that's doing well after posting its December quarter numbers. Aurobindo is up about 6 to 6.5%. And we were talking about Divi's Laboratories as well, which has touched live highs today. So Divi is also doing pretty well. Good long position seen, and this one's been indicating a little bit of cash-based buying because the delivery volumes for Divi's Laboratories has been looking good. Mridul, what about the pharma pack? We've got a lot of numbers in the last 2 or 3 days, and we've been talking to our experts, and a lot of them are liking Divi. Now, of course, it's at live high levels, but what did you make of the entire pack, about the earnings, and what are your favorites here, if you have any position in the portfolio?
So we typically avoid pharma as a sector. We find it too technical, too complicated to be generalized. But our view on the sector is, over the last 2-3 years, the sector has seen a lot of pain, both in terms of earnings, because of the US business and everything. What our understanding says that pain is probably towards the end of it. A sign of that is from the Sun Pharma results, where Lupin was a howler. So it becomes a case where you have to understand each company, their segments, which we are not an expert of. So as such, as a portfolio, we don't allocate anything to pharma. But if I have to look at something, I'll probably look at Sun Pharma ahead of anything else.
Okay. The other one I want to pull up, which has reacted positively to the numbers, is Trent. Of course, right from the word go in the morning, it had a gap up opening and it's been building on from those gains. Look at the counter, it's up now 11%. Can you just pull up the last 3 or 6 month performance as well from Trent? We'll get an idea whether it's last 3 months also it's up about 21%. Have you been tracking numbers of these retailers? Trent did well, VMart numbers were good.
So we track DMart, we softly track DMart. Again, it falls in that thesis or that thought process which we have built, that people have spent in this festive season. That has been seen across numbers in consistency. If you look at consumer numbers, their volume growth, it's been there. And that is impacting the sales of Trend, DMart and retailers like this. So not really surprised. And Trend, just like DMart, has a very good positioning, good brand, good company, good management. Hence, if they deliver number, they will do well. Do we track Trend or hold? The answer is no, but we do track DMart a lot.
Which is that stock that you've added recently in the portfolio or added more?
The last we added was M&M Finance and Page. I think that was a month back. For the last 1 month, we have been just no new ideas. We have been consolidating on our original holdings.
Okay, Shitij, I want to come to you with one more stock. Varun Beverages is up 9% in today's session. Remember, the last few days is, post numbers particularly, the stock actually fell from highs of closer to about 870 just a few days back. It came all the way down below sub 800 and from there it's picked up again. And today's session, good volumes, should also get the AV80 function of this stock, and good volumes has picked up momentum. So 847, what would you do with this stock now?
See, rightly mentioned, after testing the levels of around 850, the stock has been, was witnessing a downside and tested the levels below 790 as well. But the kind of gains with the heavy volumes we have seen in today's session, it clearly shows that the once taking control over to the prices, as the stock has already, already given a breakout above the three-day high, and on a higher side, I believe 850 to 865, that with the near-term resistance level. But the kind of volumes we are looking into the onto the charts, I really believe that the stocks still have much more potential to move beyond 900 level as well, because the broader charts are suggesting that the stock has given a consolidation breakout after a prolonged consolidation within a range of 700 to 800. And this follow buying should not be, stop beyond 900 as well. So yes, the stock has much more potential to move towards more upside.
It's Varun Beverages on huge volumes there today, up about 9%. Britannia is likely to report a quiet operational performance in the third quarter. Rising prices of milk and wheat is likely to weigh on the company's margins. Agam Vakil is here to take us through the street expectations. Agam, what's the street pricing in?
For now, the street is pricing in about a 6.6% growth in the top line. We're likely to see revenues remain flat at 16% and profits likely to rise and grow as much as 21% on a year-on-year basis. The company does not report volumes growth, but its largest segment, this is a biscuit segment, is expected to see a 4% volumes growth coming in. The company has carried out a bunch of product innovations, and that's likely to aid growth as far as this quarter is concerned. On the other hand, as you mentioned, we are likely to see some sort of pressure in gross margins to the tune of nearly 100 basis points because of an increase in milk, wheat and sugar prices. That said, we are keeping an eye on the distribution, especially which has been relatively weak, as acknowledged by the management as well, especially in the North Indian states, and see where these challenges lie and how the management is trying to take on them. But on the whole, nothing spectacular as far as expectations are concerned. Fairly steady quarter.
Agam, thanks very much for that. Let's talk about consumption as a pocket, Mridul, and what have you made out of the numbers that have come out so far in terms of the volume performances, and also what is your expectation out of Britannia?
So the numbers have pretty much been in line to positive side in terms of the expectation broadly. That is where our channel check or our thesis was working, and which is why we added Page, because from a valuation perspective, From fundamental perspective, at 22,500, 23,000, we saw a lot of value in it. Britannia is something which we track closely. While those margin pressures are in line with the thoughts which we have and the market have, what we look for here in the commentary is the confidence of management to pass on such margin pressure in terms of pricing. If they can do that, then trust me, Britannia is one of the cheapest stock in the consumption state. I know it's been up 25% from the bottoms over the last few months, but it still has a long way to go.
Do you track UPL, the numbers slated to come out?
United Phosphorus. We track it a bit. It's a rural play for us. So we typically, when we want to play the rural consumption play, the typical names are Hero Motor, M&M Finance, UPL. Now UPL should deliver a good number, because if you look at it, the Kharif crop production, the Kharif crop realizations have been pretty good for the farmers. And hence the expectation is that they will do well for the Rabi crop.
Okay.
And hence UPL should give good numbers and should show that confidence in terms of commentary also.
Well, let's figure out what those expectations are. Yash is here with that. Yash, is it expected to deliver a strong quarter?
Well, it is expected to deliver a steady quarter, but the year-on-year numbers would not be exactly comparable, because Arista financials have started being reported in their consolidated accounts starting the fourth quarter of FY19. But taking a look at their headline numbers, revenues are seen coming in at closer to 9,200 crores, which is an 86% growth on a year-on-year basis. EBITDA is seen closer to around 1,900 crores. Margins relatively stable at 20.5%, while net profit is seen almost 56% higher at 693 crores. Now, the key factors to watch out for would be the ex-Arista, which is the core business of UPL, and how that is expected to fare. Most of the brokerages, they expect it to be in the range of 10 to 13% for the company on a year-on-year basis. That apart, what is likely to do well for the company is India and the LATAM division. Latin America contributes to almost 33% of its business, while India too accounts for a large chunk of their overall revenues, and both of these geographies are expected to post a high double-digit growth, somewhere in the range of 10 to 15%. But North America, Europe, and rest of the world, that would largely be subdued. In fact, some brokerages expect that North America and Europe could even post a negative growth this time around. As a result of this, the margins are likely to be on the lower side, or more or less stable around the same figure that we saw last year, because North America and Europe, these are the high margin markets for the company. No major impact as far as the currency movement is also concerned. There was only about 0.7% of rupee depreciation, so no extra gains coming in from forex as well. And lastly, we will be watching out for any management commentary with respect to new launches and the share of the branded products to its overall revenues.
Okay, Yash, thanks a lot for bringing that heads up with regard to what to expect from UPL's numbers. Pull up Schneider Electric. It was locked in upper circuit yesterday of about 20%, and this one also came out with its numbers day before yesterday. So the reaction was positive, and the gains continue today as well. The stock's up about 18%. Our trend is at day's high with gains of 13.5%, and Welspun Corp has been going from strength to strength. And in today's session as well, you are seeing gains of about nearly 11 to 12% on this stock. Mridul, do you track Welspun Corp? The numbers were pretty healthy. No?
No, we don't. Sorry.
Okay, no worries in that. I think we've got Brijesh also joining us, Brijesh Singh of StockAxis. Hi, Brijesh. Good afternoon. Quickly, your call on the index and your top stock bets for this afternoon.
Good afternoon, Navneet. Say regarding with the Nifty has been concerned, it's still trading in the range, or I would be saying it's been consolidating downside. 12,040 or say 12,070 is a support, whereas on the higher side 12,150 to 12,170 has been a resistance. But the hourly charts are indicating a little bit profit booking would be there. So I would be going on a sell side, taking a Nifty spot value. Any rise above 12,120, one can play for a sell side with the strict stop loss of 12,170. Play for the target of 12,040. Any closing below 12,040 would be giving an invitation for 11,970. Regarding with the calls are concerned, the Two calls are there, both on the buy side. Number one is LIC Housing Finance. The higher lows formation on the daily chart indicates for the more probability of shooting up. So presently somewhere around 443 the stock has been quoting. So one can go on a long side at the present rate or any dip till 440 with the strict stop loss of 420. Play for the target of 480. Time frame to hold the counter would be a week time frame. And another counter is a Voltas. So when I posted up at that time it was 700. Now I think it has been quoting at 705. Still overall trend has been on a bull side with the volume breakout. So present rate can be used to go long with the stop loss of 680 for the target of 735. Time frame to hold the counter would be 2 to 4 trading session.
Okay, Inox also reported numbers today. While there was a dip in terms of its top line, bottom line, the EBITDA was up 2 times. There was an IiAS adjustment which reflected. The stock saw an initial dip, and then from there now it's back up above 2% at 421. Just a month ago, this was somewhere closer to 385. From there, it's been a decent recovery. But the last question, do you track the exhibition space? And within PVR and Inox, anything that looks attractive?
We look at PVR. That's a large cap that falls under our universe in terms of tracking. These things typically move according to the basis of what is the content which is coming. And that's how we track it, that how the contents have done and everything. So from that perspective, it's a natural play of consumer spending, which is why they trade the kind of multiples they do, because it's a cash generating business. We see the contents pipelines have been pretty good. The collections have been pretty good. So these businesses will continue to do well. That's the broad view which I'll have. But we don't track anything other than PVR in this space.
Okay, we'll leave it at that, Mridul. Thank you so much for joining us. Appreciate it.
Thanks.
Just before we go on and get in a sense as to what Gautam Shah has to say about the equity markets, I actually wanted to get in a sense of some stock ideas from Brijesh, and I don't know whether we covered that or no. All right, we did. So let me just go across to Gautam Shah. We spoke to him in the morning. Medium term, he believes the Nifty can touch about 13,000. However, in the short term, he feels that the Nifty move is capped at about 12,000. So listen into that conversation.
The Nifty was trading at levels of around 12,300, 12,400. It was looking a little top heavy, and it was looking a little exhausted. You might have seen in early January, you had a scenario wherein the top 5 large cap names had turned sideways as the market was trying to get past that 12,400 number. So in a sense, there was some indication that this market is factoring in too much expectation, and when it got disappointed last Saturday, it all just came off. But the manner in which the markets have recovered in the last 4 days, I think that just tells you that for the first time in 2 years, the mid caps have actually bailed out the index. And I think this has been our view for the last couple of months, that the broader markets are looking far, far stronger than the large caps and the mainline indices. And because of the strength that we are seeing in the mid caps, the Nifty is not able to break medium-term support levels so easily. Therefore, I'm not surprised that the market has come back so quickly. But after this run of the last 4 days, the Nifty itself is looking a little exhausted here. So around 12,150, 150, 160, it could see some selling pressure, maybe some range-bound activity for a day or two, which would not be such a bad thing. But irrespective of what the Nifty does, I think our bigger view is that the mid caps and the small caps will continue to run up. And there are more and more pockets, more and more themes, more and more segments within the broader markets, that are participating on a daily basis. So that's going to continue. So on the Nifty itself, I think the upside will remain capped to about 12,400, which is nothing in percentage terms. But if you talk about the mid-cap index, our bigger target of 20,000 is very much on. So we are looking at a good 2,000 to 2,000 point upside even from these levels.
12,000 as a cap on the Nifty is something that you're projecting for the immediate near term? Any longer term setup where you can give us a target on the index for a slightly longer period of time?
Yes, I wish I could give you longer targets. In the last couple of years, we've been very bullish on the Nifty every time we've interacted on this medium. But now you've come to a scenario wherein the longer term charts of the Nifty give you an indication that 2020 is going to be a sort of a dull year for the mainland indices. So it will keep moving back and forth in this 11,800 on the downside and 12,400 on the upside. But our bigger picture target for a very long time has been about 13,000. So at some point of time this year, you should see the Nifty testing a level of 13,000. But that again is nothing in percentage terms. You are just talking about 6-7% upside, whereas the broader markets are going to give you 2x or 3x return.
Okay, some encouraging views coming in from Gautam. Let's see if the bailout that we've seen from the broader markets this time around continues for the remainder of the year as well or not. Hi Gautam, good morning. I want to talk about the Nifty Bank as well, the banking stocks. Though yesterday, of course, there was some bit of outperformance, but if one were to look at the returns on year-to-date basis, Bank Nifty has actually underperformed Nifty. I think it's down somewhere about 3%. Do you expect this sort of trend to continue in the near term?
That's exactly the problem, and this is exactly what we identified early in the month of January when we noticed that the Bank Nifty was not leading the Nifty higher. In the last couple of years, every time the Nifty is moved higher, it's always the top 3-4 banking stocks that has helped it, drive to those levels. This has not happened for the first time in a couple of years. And again, if you look at the relative strength charts, you have an indication that the Bank Nifty underperformance has started, and I don't think it's going to end in a hurry. So even though yesterday the Bank Nifty did well in comparison to the Nifty, I think looking at the setup of some of the top 3-4 names, I feel that the Bank Nifty is going to be range bound, and some of the underperformers of the last 6 months like pharma, auto, metals, I think they are likely to do well and they are likely to contribute to the Nifty gains. So Bank Nifty I don't think is a trade. It will stay in a large range around 31,500, 600. There is a lot of resistance. At the same time, around 29,500, there's a lot of support. So broadly, it's going to be range bound, and you have to really trade the trading range. Also, in today's market, I think it's important to be stock specific, because on one hand, you have an IndusInd Bank which is near 52-week lows, and on the other hand, you have an ICICI and an HDFC which is trading at 52-week highs. So 2020 is all about being stock specific, and if you are in the right stocks, if you are in the right themes, only then can you outperform the market.
Okay, time to find out the Fab 4 stocks of the day, and let's go across to Sharad Dubey to find out what features in his list. Hi Sharad, good afternoon. What are you tracking?
Good afternoon, Navneet. The list is filled with earnings stocks, and the first one I'll pick up is Varun Beverages. The stock is up more than 7% today after it registered a good set of quarterly numbers, with the revenues rising by almost 55%. And also we saw strong volume growth, coming in at almost 81%. This is based on account of acquisition seen in the south and the western markets. However, the company did mention in its press release that it has deferred the enabling provision for a QIP issue. Up next is Aurobindo Pharma, which is up almost 6.6% after it reported a set of quarterly numbers where the US formulations revenue rose by as high as 22% and the European formulations rose by 14%. It was an operationally stable quarter, with revenue also rising by almost 12%, and there was a consolidation seen in Spectrum and Apcotex markets in the US. Up next is Trent, which is up almost 12.8% after it came out with a set of strong quarterly numbers when the same store sales growth rose by almost 10.5%. That is higher than its peers like TCNS Clothing and Pantaloon, whose SSG growth was there between 3 to 7%. Even India's impact was seen. That's where the margins were impacted. And the last stock of the day is Symphony. The stock is up almost 9%, seeing its biggest intraday jump since March 2008 after it came out with the strong quarterly numbers, and the revenues rose by almost 20% and the margins also expanded by 600 basis points. So the growth was seen in the Indian markets, and also the Australian market did show a revenue growth of 8%. Back to you.
Sharad, thanks very much for that. So those are the Fab 4 stocks that you need to keep in track. I also want to look at some of the losers in the session this afternoon. So while we've concentrated on all of the gainers, some big losses that have come across are from the sugar space. You've got Srinagar, which is down. Some real estate companies also looking weak. So DLF gives up about 4% this afternoon. Gujarat Alkalis is down about 5.5%. Motherson Sumi is down about 3.25%. Delta Corp, Eicher Motors. So after yesterday's big 4% gain, Eicher Motors is down about 2.8%. Adani Transmission and NMDC on poor results. Lupin is also down about 2.5% as well. Again, Lupin results came out yesterday. Today, the reaction is not all that great. About 700 is where it's capped. A quick comment, Brijesh, coming to you on any of these names. DLF, Motherson Sumi, Eicher Motors.
Water looks weak on the charts. If we check it out, the daily charts, still the stock has been trading with lower tops and lower highs formation, which indicates more downside. The stock has to give closing about 20,700 mark. Till the stock is not giving closing about 20,700 marks, the selling pressure would be continuing. So now at the present rate of 19,800 around, if someone wants to go for a STBT sort of thing, present rate can be used to go for a sell set. Stop loss can be 20,200. Look for the target of 19,300 to 19,350 zone.
Okay, Jigar Mistry of Buoyant Capital is also joining us on the show this afternoon. Jigar, good afternoon to you. Let's talk about, what is it that you're liking at this point in time? A lot of anticipation pre-budget as to what it would do for spaces like infrastructure, cement, metals, because they're all feeders into infrastructure, whether something big would come about for real estate. All of those hopes got dashed. But obviously there is scope outside the budget to do things for each of these industries, which we're seeing being taken on bit by bit. Do you feel that you could probably look at increasing allocations to some of these sectors in a portfolio?
Yeah, hello. Thank you for inviting me again. I think the budget was the dash of hope only for the select few, the top 5 lakh families in India. But if you go beyond this, I think I came 2 or 3 days on your show just before the budget. And we did end up discussing that there is absolutely no fiscal room for them to maneuver much around, right? So they did what they could have done, although I would have expected they would get done with the LTCG, but because that's absolutely a no-cost measure for them. But after what the FM did, I think what the RBI did yesterday was sort of budget, part 2.0, because they essentially allowed a lot of liquidity to flow into the system. Now, your system-wide liquidity stands at 3 lakh crores, but a lot of real estate projects, I think CRISIL came out with a report which said that although the reported GNPA is 3.3% in the housing loans, but most of those are in moratorium,
yes.
right?
So it's actually almost 10%.
Closer to 10%. Now you're not forced to recognize that for a good part of the next 3 or 4 or 6 months, which means that 1, it gives some bit of leeway. 2, reducing the CR, or rather allowing auto loans, consumer loans, and not providing CRR on that actually increases the spreads by 10 basis points at the NIM level. At the spread level, a good 15-20 basis points. So you have effectively lowered interest rate without explicitly doing so. So RBI is getting a lot more creative now, with the LTRO now, and it seems like a quantitative easing of sorts in India. Where we go from here is that one thing we discussed the last time around was that every time the corporate spreads in India sort of shrink, the market's broad base. So if you look at 2018-19, the downgrade to upgrade ratio was as much as 2:1. In April, it's come down to 1.2:1. Mr. Das was on record saying that the transmission is happening to quite a great extent. But now the spreads are actually reducing even faster. And whenever that happens, in 2018 and 19, the markets, 5 companies drove the entire Nifty. Now we are probably looking at a much, much wider participation. So I think that is the place to be in. Some can sort of loosely translate it into mid and small caps performing better. But I think the participation in the markets will get a lot wider. And I think investors should position for that.
Okay. So would you... Okay, let's work with some of the developments that have happened, and this move for NBFCs in some fashion. Is it conducive enough for people to go out and make a slightly longer term investment bet into any of these companies which will benefit from the policy moves yesterday?
Not explicitly so, because just the move yesterday is essentially one where it doesn't create demand. It reduces the cost, but it's not like NBFCs will go and say, okay, let me lend more on housing finance now. So
give them some relief though.
Some amount of relief has happened, but I think there is already a case for some NBFCs. See, there is a legitimate place for NBFCs to coexist along with banks, because they provide the last mile connectivity, so to speak, which banks, or many banks cannot do. Now within that, what most NBFCs ended up doing was borrowing at a shorter tenor and lending at a longer tenor. So asset liability durations were mismatched beyond connection. And assuming there was no liquidity crisis, they would have assumed that we'll continue to refinance this in a way that, we'll start making huge amounts of spreads. Now, after September 2018, they realized that, money is not flowing as easily as it would, and therefore some of them raised bonds, some of them compressed their NIMs, and to a large extent, the froth in the system has settled down. Correct? So at the peak of the crisis, there were two businesses that we bought. One was Canfin Homes, one was Bajaj Finance. We got Bajaj Finance under 2,000 rupees. Canfin Homes was something like 240, 250. Both stocks have performed exceedingly well. I think PNB Housing, after the recent numbers, has tanked a lot. That is one business that sort of looks interesting. Probably and arguably we are at the end of their downgrade cycle. So once things improve at a little over 1 time, it does make sense to get into a few select NBFCs.
You're buying a valuation. You're not necessarily buying growth in business as
growth in business
PNB.
Is there
For
right?
PNB Housing.
Yeah.
Okay, but the asset quality issues don't worry you too much.
Increasingly at this valuation, it doesn't. Right. So obviously, if you are going to wait for the picture to clear out entirely, then you are going to have to pay 10 times like a Bajaj Finance, right? So essentially, here you can get a few names. I think that is very similar to when we got into ICICI Bank as well. So banking as an exposure is very important to us. Asset quality is far more important there because of the size at which they operate and the penetration that they get, right? Mortgage at the end of the day, based on the economics of finance in India, you know that loan to value is fairly large, correct? So the actual loss on an actual mortgage is not going to be that high. Compare that to a microfinance or retail financing of a bank, it becomes a much bigger issue there. Correct? So there, I think credit cycle plays a big part. And to that extent, I think ICICI Bank under the new leadership still looks phenomenally good. So banking sector is one that is very interesting. To answer your first question, yeah, there was not a huge relief on real estate or building materials. But essentially, if you look at cement demand in India, it's been stagnant for almost 7-8 years. And there's some companies that have managed to consolidate, some companies that have managed to grow it to a size above 15 odd million tons, which makes them a reasonably good player, a good force in the industry. Now, as and when housing picks up, affordable housing picks up, there are few of those companies that are available at fairly decent valuation. So among those that are trading, we own Ambuja Cement, we own Birla Corp, we have for quite a while. So those are the two names that I like. Within the infrastructure space, I think we are still better off owning asset creators rather than asset owners. Right, so asset owning space, they have tried with multiple models and they have not yet found a formula that sticks. So they started with EPC, then they went to BOT, then they went to HAM. Now I think we are back to BOT/EPC. So I think that is one model that needs a resolution, and asset owners, whatever the cost that has come down, still doesn't appeal that much to us. So within our portfolio, in this space, we have employed a barbell strategy, which is you own a L&T and then you own a company like NCC. Right? L&T has not performed for quite a while. The order inflow target has been kept fairly robust. NCC, on the other hand, is one company that, for no fault of theirs, because the government changed in Andhra Pradesh, you essentially cancelled all the contracts. And now it's trading at a valuation where if they execute the current orders at hand, you're getting the company equivalent to the working capital in the company. So yeah, maybe nothing gets resolved for the next 3 months, 6 months. But what is there to lose? So if you are happy waiting it out for a full year or so, I think that is a very interesting business to own.
Okay. Well, just before we continue further, let's hear out one more voice. Companies with good management have 90% chances of giving good returns, and everything else makes up for the remainder. This is as per Ramdev Agrawal, the chairman of Motilal Oswal. AMC, who believes that the market formulas also need to evolve with changing dynamics, but an effective, well-driven management does far more good than any other factor.
So, but destruction happens because of the bad managements. Because in businesses, 90% is management, 10% is, as it is said, everything else. So if you don't get your management right, one, you don't make a lot of money. A lot of money will be made by big management. And people come here to make a lot of money. One is that. Second is that you don't buy quality. When you talk about long-term compounding, the compounding can happen only by quality. I mean, if there is no quality, it will falter. And if it will falter, it will not work out in the long run in compounding. In compounding, what is most important is, it is not a 5-year game, 10-year game, it has to be 20, 30 years game. You might stay 10 years, but the person who is buying from you at a fancy price, he is looking at another 10 years. And that guy's exit is again dependent on the next 10 years. So whether you want to stay 10 years or not, but the longevity of the company is extremely important in current valuation. So getting the management right, getting the quality of the company right. So all this QGLP, all 4 components, all of them are very important. Like when I met Buffett, when I heard about Buffett in '95, first I thought quality is very important. So I became bhakt of quality, without bothering of quality at any price. That was the game to start with in '95. Then in 2003, I read this book, Intelligent Investor, which was lying in the rack. I thought this old man, what new things he would have. Our Buffett knows everything. So I didn't bother about that book. So when I read in 2003, margin of safety, when the market collapsed in 2000, then we learned margin of safety. So quality also you cannot buy at any price. So then QNP came. Okay, then we were practicing QNP. Growth was in any case part of the DNA. Then in 2014, we realized that G is equal to R. Growth and return is one and the same mathematically. If the company grows at 45%, so in 2014 we did a number, between 2014 and 14, Infosys grew at 43%, and the stock returned 43%. Colgate grew at 11%, and it gave 11%. So we realized that G is extremely important. And quality is important, G is important, but then you want to make a lot of money in compounded way. So longevity is also important. So quality and longevity is important in quality, longevity is important in growth. So like that, you're learning. Now, having written QGLP in 14, again, we missed out on the quality of management because we thought it is not numerical and it's very qualitative. How do you figure out? Then we had 2 accidents. Yeah. Then we said, let's write it. So this time we wrote this quality of management also. So like you are plugging. Again, we'll commit some mistake in next 1 or 2 years. Then again, we'll find some other method.
Right, words of wisdom from Ramdev Agarwal. You don't want to miss that. You can watch the entire interview on our website, www.bloombergquint.com. You can read more also into that. So shifting focus back to markets, TD Power System is locked in upper circuit with gains of 20%. I think they posted their numbers yesterday. They posted a profit versus the loss figure in the corresponding quarter. And precisely that's the reason why you are seeing the stock inching higher. I also want to pull up Fortis Healthcare. After a while, the stock's been moving. And in fact, not just moving, it touched its 52-week high mark in today's trade. It's up about 4 to 4.5%, and you've got some moves coming on Z, which is now up about 6%. It's at 250 right now, Brijesh. The sort of recovery that we've seen on Z Entertainment in the last 2 sessions, would you take any bet here looking at the charts?
Still trend has been down on a longer term time frame on the chart, but suppose someone wants to play for a swing based trading, I would be suggesting keep a strict stop loss of 243, look for buying at the present rate for the target of 260 to 265. The stock has to be closing out 280, then only from short term to medium term it would be coming out from a bear grip.
Shitij, United Spirits too is at 52-week high. It's up about 3 to 3.5%. If somebody is holding long positions here, what would your advice be? What are the levels on the upside that you will advise?
See, on a short-term basis, the stock has given a sharp breakout with the heavy volumes, say above 660 odd levels. And if somebody is holding the long positions for say trading perspective as well, one can hold on onto the stock. As currently stock is trading around 673, 674 odd levels. You need to trail your stop loss towards 665 levels from here on. And I believe stock has still much more potential to move towards more highs. So keep a stop loss below 660 from here on and keep your long position intact.
Okay, keep your long positions intact on United Spirits. Jigar, where is the defensive bet coming, in the investments or you guys are making? Because I'm not interested in auto and pharma for the time being. Even in IT, I don't think you guys have exposure to any large cap company.
Yeah, so essentially with IT, I think we might see a very subdued rupee barring a few unforeseen events at the moment, because you're looking at arguably a $40 billion surplus on BOP for the next 2 years. So CAD might be a 40 billion deficit, but the amount of FDI and FI inflows we are seeing, I think that might top $80 billion this year and hopefully next year as well. In which case, you're getting the front runners in the IT pack, TCS, Infosys, it's something like 20 plus PE. At a time when the demand environment is rather subdued, where rupee is not really helping margins and costs are still inflating. Right? So why would I want to pay a 20 PE just because there are some ETF flows which are keeping these stocks higher? I might as well go ahead and buy something like a Scient or Persistent or eClerx, where they're trading at something like 9.5 times. They're not small companies. They are almost 14,000 plus employees for Scient. That's the company we hold. Niche R&D for aviation's business. Some slowdown, yes, currently, but it's picking up fairly well. So I think, so defensive bets again, right? The way to think about it, the way we think about it when we build the portfolio is that risks for me are twofold. One is, what is the possibility of me losing capital? Just because the stock is volatile doesn't make it risky for me, right? So if we are holding it from end to end, when I want to sell that business, would I end up losing money or not? And the second most important risk, which I think a lot of people are not accounting for today when they hide into so-called quality, is that of an opportunity risk, right? You've seen number of instances like Coca-Cola in the US. From 1998 to 2016, for 18 years, that stock delivered 0% returns. Hindustan Unilever, which is the defensive story in India, delivered 0% return between 2000 and 2010. So essentially, if you end up paying a lot for the business, no matter how good the quality of the company or the management, it's unlikely that you will make money in the relatively short term, which is 4-5 years, in which case that is a risk to us. So our way to manage the defensive space is slightly different by not overpaying to start with.
The better question would have been then how are you hedging the portfolio, but I'll come back to that. Let me get some closing strategies from our techies then, since it's just 10 minutes to go for markets to shut shop. Brijesh, I'll come to you. Any BTST or any STBT for Monday?
BTST, Navneet, Biocon looks good on the chart. The stock has been trading well above the Bollinger Band, that is 202, and the previous swing high has been broken. So keeping a stop loss of 302, one can go for a long side. Right now it's quoting at 310 and play for the target of 320. Any closing above 317 on a 17, then the stock might retest its 52-week high, that is 327 around. So for a short-term bet, and even for the BTST point of view, it's look promising to play on the long side.
And Biocon is at day's high, gains of 5% seen. Shitij, what about you? Your closing strategy?
Yeah, fortunately, the Biocon was also on my radar, but nevertheless, the other stock I have picked for today as a BTST, the stock is from the metal counter, and the stock is JSW Steel. Currently, stock is up by nearly 1% and currently trading around 279 odd zone. So I believe, yes, the BTST trade can be taken into JSW Steel, because I believe in a coming week, the metal counter once again should outperform the market. And other stock, again, I would like to take as a BTST is from the metal counter once again. The stock is Hindalco. The stock is currently trading around 197 odd levels, and the kind of a recovery we have seen from the lower levels, we can say it's almost a V-shaped recovery onto the technical charts. And on a higher side, once a move to above 200 levels could trigger once again a short covering into the stock. So Hindalco and JSW would be my pick as a BTST trade.
Those are some closing ideas. Keep them in mind. Jigar, you want to comment on the metals pack? And obviously, the China factor is very dominant in terms of determining our prices as well. But it looks like the cycle is turning for metals as a space. Do you feel that it's time to be in this buzzing space? And it could be a big value and return churner?
Unlikely, Devena, because what's happening is that historically when I used to track metals, we used to say that if you buy in November and sell in February, your annual returns are done, right? So that used to be the heuristic we used to work with. Now, at that point in time, this period is very different because the entire northern hemisphere is snowed in, right? So China, parts of Russia are snowed in. So they're not producing as fast as they normally do in the year. And demand for the Western countries are still strong. So that creates a spike in prices, which if you seasonally adjust is not that big a number through the year. Now currently we are in the regime where no country is actually going ahead and building their entire ecosystem, right? China did that between 2001 until 2008 when it used to import everything. India is doing it, but it's very small today. I think we are some 130, 140 million tons on a base of 1.3 billion tons of steel production. So it doesn't really matter if you're growing at 5 or 7%. And the third trend is essentially where every country is being, more nationalistic, more inward-looking, which means that every bit of barrier is being pulled up. It started with Europe, then US did it, then India also did it. So now it's very local factors. It's not really the global super cycle. So you have to be extremely fast if you want to pull something in metals. I think a large part of the rally is behind us. But some names are interesting, like JSPL, where they're still in a special situation, sort of a case. The debt is at some 45,000 crores. Market cap is much smaller relative to it. But something like a global major, Tata Steel or JSW Steel, I doubt if that can make you a lot of money over longer terms.
Okay, got that. Jigar, we'll let you go on that note. Thank you very much for joining us this afternoon. We've got about under 10 minutes left to go for market closing, and it doesn't look like the color of the market has changed much. It's still down about almost 0.5%, 12,092 on the Nifty, 120 points lower for the Nifty Bank. Just, talk a little bit more, and Shitij, I want to come to you. On stocks like Godrej Properties at 1173, through the day it was trading under. I think now it's suddenly seen a prop up. It's back in the green. But 1173, is it looking a little steep right now, considering the last few days of move?
See, if I look at the overall chart structure of Godrej Properties, if I particularly look at the broader charts, the stock is still looking promising to me, as the stock is continuously maintaining its bull trend and can be seen trading in a higher high, higher bottom kind of a pattern on daily and weekly charts. But yes, on a daily charts, the kind of a recovery we have seen from lower levels, say from the psychological level of 1,000 rupee to 1172. Why I believe before taking a fresh position, one need to wait for a dip into the prices towards 1100, 1120 levels. Yes, from there on the risk reward would be favorable to me. And yes, on a higher side, a move to above 1200 levels could once again add up a follow-up buying into the stock. So overall structure is looking good to me, but before taking a long position, one need to keep a dip into the prices, as stock has already taken a rally in last 4 to 5 trading sessions.
Okay, gentlemen, stay on. We'll start wrapping up the markets for you and then taking final thoughts from both our experts. So, the days ended with a bit of a quiet close, so about 1/3% lower for the 3 benchmark indices, maybe slightly more for the Sensex, but in or around 1/3% to 0.5%. The mid cap and the small cap indices will come up on your screen, and there too it's been a bit lackluster, though you would have to say that the mid caps at 0.5% higher are outperforming, and they did outperform at the start of the trading day as well. So the bout of outperformance from the mid caps has continued. But what have large caps done? That's the key question, isn't it? So Z bounces back a little from yesterday's closes. NTPC, it's been a bit of an old economy kind of a day today, wherein old economy stocks are doing well. NTPC, Coal India, ONGC, Hindalco, Bharti Infra, UPL, that's the set of stocks which are actually done well today. What has not done well? Autos, correct, big time. So iShares, Tata Motors, M&M, Tata Motors, they've all fallen as a pack today. Reliance has been a big disappointment, and Bharti Hetal loses a bit of ground, as does HDFC. So between Reliance, HDFC and a couple of others, you know what your top losers have been in the session today on the large caps. But the broader markets, maybe a mixed bag, because small caps were placid, but the mid caps did reasonably okay, Navneet.
Absolutely, Neeraj. And there were a lot of movers on the broader market side. Of course, you had the mid-cap index first, which is closing with gains vis-a-vis the frontline indices, which have witnessed some bit of cool-off after rallying for last 4 sessions. So let me begin with some gainers. TD Power System, the stock was locked in upper circuit with gains of 20%. Largely, this has been an underperformer. If you look at the returns in last 2 or 3 years, this time around they posted a profit versus a loss figure, and maybe the street was enthused with that. Trent came out with the numbers yesterday, and what a performance this one has been posting for last 2 or 3 quarters. The same-store sales growth was at 10.5%, and hence that reaction coming by. As you can see on the screen, the stock's closing with gains of about nearly 11%. Fortis Healthcare was also active, and the volumes were quite decent. This one touched its 52-week higher levels. So we'll see if this move continues or not. And from the pharma space, Divi's Laboratories clearly has been an outperformer in the last 1 to 3 months. So today also it touched its life highs, and it's closing at the highest point of the day, which is technically viewed as a positive sign. Symphony came out with the numbers. Margins expanded by 600 basis point and interim dividend of about 18 rupees. I think the street was quite excited with that. 10% gains for this one. And you had Shankara Building, which was locked in upper circuit today with gains of about nearly 10%. United Spirits also touched 52-week high levels, so good going for United Spirits too. And lastly, I just want to pull up Jamna Auto. I think the counter rallied in the last half an hour of trade or so. There you go. It's closing with gains of about nearly 10%. On the losing side, DLF is down for the second straight session after posting its numbers day before yesterday. So negative reaction post the numbers. Motherson Sumi also didn't have a great day, closing with some bit of cut, some selling pressure coming down, every recovery for the stock. And you had IiAS Financiers. This one too saw some selling coming by. And look at that. I think just in the second half, you saw that selling down 6%. NMDC reacted negatively to the numbers, and also reacting negatively to the numbers today was United Breweries, which came out with its set of numbers post-market hours yesterday, and the stock's down about 2%, Devina.
All right, wouldn't say cherry on the cake because the last day of the week didn't manage to maintain the gains that we maintained. We would have had a spotless week, but for today. We've got a cut of about 0.5% on the Nifty 50, down below its 50-day moving average. For the Nifty Bank, losing about 145 points. Sensex also losing out in today's trade. What were the key contributors to these losses? Let's quickly take a look then, and then we move on to the weekly performances for the index. Axis Bank on the upside, emphasis on the upside, but what dragged the index were HDFC, Kotak Mahindra Bank, heavyweights there from the banking lot, and Reliance Industries losing out about 21 points. To the weekly performance of the index then, on what's done well this week and what's not. So it's the metals pack that's really shined. BPCL2 aside from that's up 10%. Bharti Hetal, Indian Oil, so all of these names very active. What's lost out has been an ITC, Z, Aisha Motors, even though it covered up some yesterday, but today it's given back. Hero Motor Corp and Bharti Infratel and Kotak Mahindra Bank.
Yep, and sharp bounce seen post the budget day fall. As you can see, Nifty up about 3.5%. Take a look at the broader markets as well and see how the Nifty mid-cap index performed for the week. Remember, this time we're comparing the numbers from Saturday to today. So mid-cap index once again outperforming, up about closer to 5%. You had the top gainer in the form of Ajanta Pharma, which also came out with its numbers this week, 22% gains. Graphite makers were in focus today as well. So HEG up about 20%. Godrej Properties witnessing gains of about 18%. You had a whole host of gainers, JSP, and Natco, Mahindra & Mahindra Financial, and RBL Bank, by the way, recovering this week, almost closer to 11% gains coming by. On the losing side, you had Manappuram Finance, and the losses are primarily because of the fund exiting almost 5% stake this week. Varroc Engineering was down, Exide, V-Guard, Indian Bank were a couple of other losers alongside Mangalore Refinery.
Closing comments then. Let's come to you, Brijesh. First off, on Monday, what's it that you're going to be watching out for?
See, Devina, as I have said, the Nifty had stuck up to the level of 12,150 or 12,170. It has not able to cross that level. And on the hourly chart, the oscillators were making a low highs formation. So that has been known as a negative divergence. And now coming to the Nifty, it looked like there would be a little bit more correction left, and after that we can again resume on the higher side. So 12,000 and 12,040 level, I would be watching very closely. We should not break 12,000 mark. So this is the level to be watched on the downside, whereas on the higher side again 12,170 would be the level to watch. Whereas the Bank Nifty has been concerned, 31,450 has to be crossed. Then we can see an upside rally. And so overall, it looked like another consolidation day would be there on Monday, Tuesday, and after that again we might start moving up.
Shitij, what's going to be your closing call?
I would be rather comfortable keeping a focus on a stock-specific moves, as the index is currently looking to me that the consolidation phase we might witness in coming week, because the index has already taken a rally from the lows of say almost 11,600 to 12,150 levels. So a minor pullback rally is expected towards say 12,040 to 12,000 levels, which is a very crucial support for the Nifty moving forward, and it would act as a psychological level for the Nifty as well. So for an index point of view, I'm looking for a consolidation phase at the higher levels. Rather, we should be focused on a stock-specific moves in coming week.
Okay, got that. We leave it on that note. Thank you so much, Brijesh, as well as Shitij, for joining us this afternoon. And as we end the show, here at LIC Chairman, Mr. M.R. Kumar, who says he's not surprised with the government's decision to list the public sector behemoth. Ruling out any threat to its employees or policyholders, Kumar says the government will at no point withdraw its sovereign guarantee, thus ensuring security to oil. Thank you for watching.
Okay, this has nothing to do with privatization. Government is only possibly divesting a part of it. And there are most of the public sector banks today are listed. New India Assurance is listed, GIC Re is listed, all these listed, they continue to be government companies. So, absolutely there is no problem for the staff or the employees, they will continue to be LIC employees, which is going to be more or less wholly controlled by government. So, I don't see any reason why, I mean, there is a reaction, no doubt there is a reaction, but then I think we will be talking to them and making them understand. एक बात ये, दूसरी आपने claims के बारे में पूछा, there should be no problem for policyholders at all. And Madam FM has gone on record saying that sovereign guarantee will continue. So that being the case, I don't think there is anything to worry about for the customers as well.